Hey, Tom, it's good to see you. We have a great question today. Are annuities a good investment? As stocks struggle, sales of annuities reached record highs in the second quarter of 2022. It actually hit $77.5 billion. That's the highest quarterly sales ever recorded. So, we've talked a lot about creating a stable income in retirement. So, I just want to start with fixed rate annuities. What are those?
Yeah, so annuities, obviously, they are a contract between you and the insurance company. Fixed rate annuities, there's two different types. There's something called a multi-year guaranteed annuity, and it's just a regular fixed annuity. And typically, what a multi-year guaranteed annuity is an annuity or an insurance contract, if you will, that has a fixed rate of interest for a particular period of time. So let's say 5, 17 years. So let's just say, hypothetically speaking, that it's a 3%. And there's a 3% interest rate that is guaranteed for that period of time. So if it's 5 years, from year 1 through 5, you're going to get 3% interest.
Mhm.
A fixed rate typically has an introductory rate, maybe 3%, and then the subsequent years after, from 2 to 5 or 2 to 7, 2 to 10, those rates change potentially, and those are
Mhm.
called renewal rates. A lot of clients like to use those just because they want safety, and they want to get some sort of return on the money that they have, maybe sitting on the sidelines.
Because they're principal protected too, right?
Absolutely. So there's zero. The floor is zero. So if the market crashes, you don't have to worry about losing anything. It's a safe investment.
Right. Okay. So speaking of that, let's take a look at scale of risk by annuity type. So we just hit on fixed annuities. Let's hit the other end of the spectrum here. What are variable annuities?
Same type of deal as an insurance contract between you and the insurance company. However, what makes these a little different, they have a security aspect to it, meaning that they have sub accounts. So they are subject to market volatility. So if the market crashes, goes down 15%, those sub accounts can take an impact. So those are the high risk annuities. So if you don't want any risk and you want to take your money out of the market, I wouldn't recommend leveraging those. You want to look at either a fixed index or fixed annuity side of the spectrum.
And you said you don't even sell variable
I
annuities.
don't sell variables, no.
No. Okay. So in the middle of that risk scale, we saw indexed annuities. What are they? I feel like that's kind of the third tier that a lot of people are familiar with.
For sure. They still have safety. They have a zero floor, so if the market goes down, you won't lose anything. What makes them a little different from the fixed side, and then also the variable side, is that they are associated with an indice. So it can be like the S&P 500, or it can be a proprietary indice that the insurance company has created, and they participate typically in the upside, either a certain percentage, or it might have a participation rate where if the market goes up, 50%, you may get a certain percentage of that upside potential. A lot of clients like those because they want to make some money in the market. They just don't want to have the potential to lose anything. So I leverage those with a lot of my clients. I put them in the fixed index annuities if they want to participate in the markets.
Okay. So would you recommend then that risk averse investors allocate a portion of their bond portfolio to annuities?
Absolutely. Right now, as me and you were talking here earlier, there's an inverse relationship between interest rates and obviously bond
Mhm.
portfolio values. So as interest rates go up, bond values go down. So right now, when you have the stock market taking a hit, clients are losing on both ends of the spectrum when you have that bond and also that stock portfolio. So I like to look at fixed index annuities or fixed annuities as an alternative. So if you do want to have safety, you want to have some growth potential, then yes, let's just look at maybe allocating some of that money that's in your bond portfolio to actually an annuity conversation.
Okay, so one more question for you. There are also ETFs or mutual funds that can accomplish the same goal and can be a lot cheaper. So, how do you help an investor determine what's right for them?
I look at what their overall objectives are,
Right.
and what their risk tolerances are, and then I make my assessment based on that. I typically use ETFs just because they're cheaper. They're a cheaper play, and they move with the market on a daily basis. So if clients are looking to have a safer play, or not a safer play, but rather a cheaper play, then the ETF conversation may be a better strategy for them, overall cost of managing a portfolio.
All right, Thomas, this was really helpful to break this all down because I know a lot of people have kind of a love-hate relationship with annuities. So if
Yeah.
they would like to talk through any of these options with you further, what's the best way to reach you?
Yeah, they can definitely go to my website, martinheritagegroupllc.com, schedule a time off there. They can give me a call, 651-503-6064. And then they can also shoot me an email, info@martinheritagegroupllc.com.
All right, Thomas, thank you.
Thank you.